Hello, all. We'll start in another 2 minutes so that the entire social media, the network that we have created, gets this feed, and then we are ready to answer those questions. So let's wait for maybe a couple of minutes and then start our sessions. Thank you for joining in. So if you can all hear me, just give me a thumbs up or say a hi. Where are you joining from? If you have any questions, you can post those questions straight away. But if you could just tell me that if you're able to hear me, see me clearly, that'll be great to start this session. Nothing yet. So, okay. Great. I see few people logged in already. While I don't see thumbs ups yet, maybe. Great. So I'll start the session though, nevertheless. If you have any questions, feel free to ask me right away so that I can answer that. Today, I thought, I mean, in general, we do ask me anything sessions, as you know, around Tuesdays every time, and that is around 7:30 p.m. But today I thought it's the beginning of the month, and what a note we have had to begin with today, with market zooming up and closing at all-time highs. So I thought today is a good day to start, or at least converse with you and understand your questions so that I can give my viewpoint on those questions. While I also wanted to start off with few questions that I've got on WhatsApp and also on other medias as well, so that at the end of this 1 hour, we all have some perspective on what is ahead for Indian markets, where are we heading, right? So please feel free to ask your questions so that I can answer them, all of them live. Okay, thank you. So now I'll start by giving you some perspective on today's, especially today's market moves, and also get you back to a little bit of what happened maybe a couple of days back around small caps. Okay, so today, as against expectation of a lot of investors, a lot of economists, the GDP number came in as a surprise, as you would all know by now, because it's all over the place, everywhere on the media today. They are talking about it. The GDP number came in at about 8.4%, right? If I remember right, it was 8.4%, as against the expectation of 6.6% as per live mint, or maybe a lot of people would have expected about 7.4, 7.3% or so for the last quarter, which is a little unheard of. I mean, to be honest, should I, if I were to tell you the truth, were we expecting this kind of a number? No, but economy does what it does, and only it knows what is the right number, or what is the way in which growing. These are all estimates. You estimate a certain number, I estimate a certain number, so we generally can go wrong, and that is what has happened at this point in time. But this is a great news for India, right? Primarily because if you are estimating that your country is expected to grow at 7%, and tomorrow the NSO, the organization that calculate your GDP, come and say that India is growing at not at 7%, but it's growing at 7.5%. It's a huge differential for the country, because the size of the country is so huge. Even a point 0.1, point 0.2, 0.3% makes a huge difference. So that's the reason why today market started recalibrating its earnings, primarily because most of the companies were estimating a 7% growth and also projecting their numbers, saying that, okay, If the country's growth is 7%, if the inflation is 5%, which is total of 12%, nominal GDP growth, just for an example, I would beat it by about 4 5%. So I'm expected to grow at, let's say, 16, 15, 16% or so. And that is what I've been projecting to my investors, to the markets, to the stock exchanges. But today, if the country is growing at 7.5%, and if the real GDP has gone up, sorry, the nominal GDP has gone up to 13% or 12.5%, then I would end up growing at about 18, 19% or so. So the earnings number have to get changed on the positive side. And market is always smarter. It it always estimates things much in advance. That's why market gave a roaring welcome to the GDP number that came in, and that resulted in market shooting up by Nifty. I'm saying shooting up to about 22,340 or 338 today, closing 1.6% higher, right? So that is about the introduction. I will just hold on for now before you. I see some questions. No questions yet, so I'll continue. I'm surprised that there are no questions and today it's all about market. So let me just see. Just wait. Give me 1 minute to check any questions. Okay, no questions till now. Interesting. Great. I'm just checking it if there are any questions. Cool. Now, just to get back to where I was saying earnings are expected to change with the country's growth. This led to EPS growth. Yes, Amit, EPS growth changing, right? If let's say you're estimating, just for an example, no recommendation, Reliance is expected to grow at 15%. Today, you are estimating that it'll grow not at 15%, but at 16, 17%, because the country in itself is growing at lot higher paces. So that led to a re-rating of EPS, earnings per share, which even at a constant price earning multiple, PE multiple, would mean that market can achieve higher numbers in a shorter period of time, right? So just to give you more numbers, if FY24 number or FY financial year 25 or 26 number of Nifty was projected at about 1250, okay, and if in a normal case you give India's GDP growth, India's growth, the valuation as 20, which is PE is 20, EPS is 1250 at the end of FY26. 20 multiplied by 1250 is 25,000, which should ideally happen by the end of this year. I mean, if someone asks me questions, I'll tell you how it works. But because this is an election year, looks like the current team will continue to be at the helm of affairs going forward also. The market can be determined not by logical reasoning of EPS, but sentimental reason that the current PM will continue. So the 25,000 number that we are expected to get by the end of this year can happen now itself. When I mean now, before or around June itself. That's the reason why there is a solid case that investing at these levels also. I've told this before as well. I've told this in January also. There's a very solid case that investing at these levels also could lead to a good 15, 14, 13% kind of a return in large cap in itself. Okay. So I think that's the reason why today large cap shot up significantly, while mid cap and small cap didn't participate as much as it was expected out to be, primarily because we all know by now small caps are overvalued. SEBI is telling it. It is high time that you look into the details, you look into each of the portfolio that you're holding, and making sure that your portfolio risk comes down significantly, right? So please have a deeper look at where your portfolio is currently, how it is allocated, reduce the risk in the portfolio as much as possible, and try and move away from large cap, at the earlier, sorry, small cap at the earliest possible time. Let me go back again and check if there are any questions. Surprisingly, there's okay. I see some questions here. I see only one question, which is from Amit. EPS growth. Um, so, what's your question, Amit? Sorry, I didn't get your question. If you could just repeat your question. What do you mean by? I mean, is this what your? I mean, what is EPS growth? Are you asking that question, or if you could just be a little more detailed? What is your current allocation today then? Thank you, Niksha, for asking that question. At Mira Money, we have always believed that, paying the right price and not paying obnoxious price for any growth is the right strategy for investors. There are two ways to grow your portfolio or increase your portfolio returns. I keep repeating this. One is by taking additional risk, and if the risk pays off, your returns are higher. The second way, which is a better way in terms of journey, in the longer run, it works better. And I'm telling this out of my 20 years of experience, is that reduce the risk in the portfolio as much as possible. Not when you make too much of profits, primarily when you're the asset that you're holding shoots up significantly in value for the growth it is offering. I know it's a little technical. Let me simplify it. So for example, small cap is expected to give you better growth than large cap, the companies I'm saying, right? If there's a smaller company, it is more agile, it can grow faster than let's say an HDFC or an Infosys, because it's a large size company. So you pay slightly higher valuation for a small cap company because the growth is expected to be higher. But what we see today is that the growth that it is promising to give versus the price that you're paying today is very high, leading to a bit of a risky situation, which would mean that you may not make returns in the next 1 year, primarily time correction, or it can dip from here, leading to price correction also. So we are at this moment avoiding small cap as much as possible and have increased our allocation in large cap to 90%. Yeah, you heard it right, Nisha. It is 90% of our portfolio today has large cap, and just about 10% of our portfolio has got mid caps. So 90 large caps and 10% mid cap. Now you may say, why uh, so much in large caps? I'm an aggressive investor. I'm okay to take risk, right? That is what you may also think. While yes, you may be young, you may say, India is growing. I'm ready to take those kind of risks. But risk is not, you risk doesn't mean you get into a crowded area blindfolded. Risk doesn't mean you drive a car at a speed of 70 in an extremely overpopulated area, right? You need to change your gears. You need to bring down your speed as things become riskier. If it is an open road, yes, you are allowed to drive at 60, but if there is too much of a traffic around, will you drive at 60? If you drive being aggressive, you will end up making accidents, right, or meeting with accidents. That's exact same theory happens in investing also. Just because you can take risks doesn't mean that you should go 100% on small cap or 50% on small cap. You need to measure the price at which you are entering something, and if the price is too much, you need to reduce it. If the price is like an attractive zone, like what happened in the year 2023 February, where small cap was trading at dirt cheap prices, that is when you should go very, very aggressive. We went to as high as 60% in small and mid cap in Feb 23. And today, like your question, to answer your question, we are at 90% large cap and 10% mid cap only. I hope I answered that question, Niksha. Thank you for asking that question. Okay, I have a set of questions coming in from Paris. Um, Hi, what's your take on healthcare fall in the last two days due to CGHS scheme? Or is it a good opportunity to buy? So we are in general pretty positive on healthcare or pharma as a zone. Not so much about healthcare, but in general we believe it's a good time to be in pharma. Okay. That's a sector that we are pretty good about. Healthcare, I think, because of COVID and the kind of money that people made, the hospitals and few other ancillaries made, it is a little overvalued, and that's the reason why maybe CGHS was a reason for a lot of profit booking. But if you ask me, we are neutral on healthcare, but we are pretty positive on pharma because the valuations are looking attractive, and going forward, we may see significant amount of money getting chased there, leading to significant amount of returns for investors. So that is one sector. Pharma is one sector we like. Healthcare, because we are neutral to a little negative. So I would still believe that I would avoid, healthcare at this point in time also. So Paris, one question around Mira. Okay, what is the frequency of rebalancing in the platform that we have built, Mira Money platform that we have built? Yes, so we have gone live with our Mira Money platform on Android and also on iOS. You can download, invest as low as 10,000 rupees, and where we manage your money actively using passive funds. Right? It's very interesting, right? We use this word active and passive together. More or less, while I can't say that it's a PMS, but it is a, for a 10,000 rupee entry, you get you get your money managed by experts like us and Naveen and Mohit and the entire team. So the frequency of rebalancing is, in general, we would never want to move away from a good portfolio till the time the risk becomes heavier. Okay. So for all in most cases it will be beyond 1 year, but then there are times like these where in one single shot we made significant amount of returns in large cap, in mid and small cap. Right, this has been a little bit of a aberration, a little bit of a different kind of a year this year. So, because we made significant returns and the risk tilted, we rebalanced our portfolio once in August when Nifty's portfolio gets rebalanced, and once in February. So in general, we want to continue as long as the portfolio looks solid and the growth looks good. But sometimes, we may end up exiting in 6 months' time itself, or reducing the allocation in 6 months' time itself. So anywhere between once in a year or twice in a year is when the rebalancing will get done on your portfolio, Paris. Right? Thanks to this rebalancing, last year was significantly good for us because in general we are expected to generate about 2 to 4% more than index. That's what my experience says. But last year was excellent because we generated about 33% return on clients portfolio. This is the high growth basket that I'm talking about, which you can see in my app. We generated 33%, while the market, which we, or the benchmark which we compare us again, which is Nifty 200, generated 25%. So we beat the benchmark of Nifty 200 by 8% with very simple index funds, right? And the best thing is the cost for anybody to manage today this kind of a portfolio, if you go to an advisor like me outside, is very high, 2%, 2.5%. But we could do this at a cost of 0.6, 0.7%. No other fee. That's it. So people are liking this idea, Paris, and thank you for asking this question. And what is your, okay, is there, I'm ready to ask the next set of questions. Any other questions, Paris and, Niksha, if I answered the question, please give me a thumbs up. If you have further questions, yeah, I would be very happy to answer those questions. Let me go to the next question till then. 1 second. Okay, questions are coming in from the YouTube channel that we have. So one of the questions is, what is our take on the small cap? What is our take on the rule that SEBI has come out with on the small cap? Okay, by the way, there is no rule that SEBI has come out with. It is just that SEBI is increasingly getting worried about retail investors like you and me investing in heavily in small cap and mid cap. Okay, that is what SEBI was worried about, purely because of valuations. See, everyone knows that market can become a little frothy, and most of the people go with the trend and end up getting stuck in the froth. That's a reason why SEBI right now proactively came and asked fund managers to stop taking money in small and mid caps, primarily because if there is froth and tomorrow there is a correction, it would hurt you and I, retail investors. For knowledgeable investors, we have already moved. For example, I've been here for 20 years. It's not that I know everything about markets, but we have already moved significant portion out of small caps. And I've been telling this live every other LinkedIn AMA or any AMA that I've gone for. We have written about why small cap is also expensive. And today, in this week, SEBI has clearly attacked small cap valuation, saying it looks a little frothy. Now, your question is, does it mean small cap will fall? You never know. It may not fall, but it may not grow also. So there are two types of corrections in the market. One is the correction is called one type of correction is called price correction, which we have all seen in 2022 in small cap, where it came down 20 or 17 odd percent in straight line, primarily because of Russia war and overvaluation. Then there is something called time correction, where your market levels are at the same levels, but it is after a year. In the sense, you were at 12,000, just for an example, your index was at 12,000 in the year Jan 2022, 2024. Index was at 12,000 in the year Jan 2025, which means your prices got corrected, but your earnings has improved, and that's the reason why your PE or the valuation comes down. So there are two types of general corrections that we see. So small cap may not crash, small cap may not have a very bad landing, but it would maybe go down, go up, go down, go down, and may not generate any positive return in the next 1 year or so. Quite possible. So we believe our take: small caps are expensive. We are avoiding it. If you are someone who has got a lot of small caps, maybe you should go deeper into those kind of companies and do a research. And if you don't have the time to research, then I think you should choose a good advisor. I'll shift to LinkedIn. So Manjeet has asked a question. Thank you, Manjeet, for the question. How do you see growth in EV sector in the next 2 3 years? Who can be the prominent players and emerging players? Would there be a drastic change in current ecosystem? I think there is a lot of focus, especially from the government, to move away from fossil fuels. So I definitely see growth. I definitely see the landscape changing. I also see that more and more adoption, the tax structure getting better, the entire, the way the cost of buying a vehicle today or doing a lot of things around fossil fuels is going to, around EVs will come down for sure. But I think the euphoria around EV is today more or less factored in for. So the price at which many of these companies are trading is a little high, that is for sure, and factors in too much, in my opinion. So until unless you see a new company available at a good valuation, you may not really end up making too much money in the EV space at the moment. It was a good story, like the PSU story some time back, but I don't see too much of returns coming in from EV as a story at this moment. To answer a related question, if at all you have, let me first see if there are any other questions, Manjeet. I hope I answered that question. So I am not yet bullish, nor I'm not as bullish on EV space as maybe I would have been a couple of years back, or few years back, or so, right? So I'm not really. Sorry, this thing keeps coming in. Okay. What's your view on private bank? When do you expect them to recover? Vinay, I'm extremely positive about banks in general and private banks in particular. We believe that once this election news settles down, the entire uncertainty about what is going to happen around elections comes down, right? The guys who are sitting on the fence, which is these a lot of these large and mid-sized players, private players rather, will start expanding rigorously, right? Because if the GDP is growing at 8.4%, it means there is definitely scope for growth from here. And all these private sector bank, and today if you actually see, most of the growth has happened primarily because of government spending. It's a central government spending, private sector enterprises spending, public sector enterprises spending, and very little from the private sector. Though if you see today, Tatas, Birlas, Adanis, Ambanis are also setting up shops. But it is a second level that needs to start investing in India, and that will lead to a significant amount of top line growth to the country's economy. When that starts happening, when these people who have a clean balance sheet start coming to the banks and start borrowing and setting up capacity, because their capacity utilization is already at 100%, 70%, 80%, that is when private banks will start showing great returns. It is not too far. It may so happen that private consumption will be sorry, the cap private capex will be so high that the banks will not have money to lend, in the sense they don't have deposit enough deposit to do it. It may so happen. So I think maybe in the next quarter or so, you should see, or maybe after June or so, you should see a definite amount of movements on the private banks, and we are very positive about it. Primarily because one is the growth is expected to be solid. Second, the price at which they are trading today is extremely attractive. Now, I don't know, I don't do stock portfolio, so I don't know whether HDFC is better than Kotak or if Axis is better than ICICI Bank. I don't know that. So that's the reason why I go with indexes or few active banking funds. But if you know, okay, if this situation pans out the way you are thinking and I'm thinking, you should definitely then look at adding private banks in your portfolio. I hope I answered that question, Vinay. Okay. So I don't know. I am not. I don't know how to get questions. On StreamYard for some reason it is not coming through. That's why I'm going a little bit of a back and forth. Let me go back and see. Okay, Avinash, thank you for the question. How do you see the next 2 to 3 years for finance sector and NBFC, especially large cap performance? I will answer. I've just answered about banks. I think few solid NBFCs. One of my favorites, which the story about which I've already written, is also ripe enough now to. It's like, it is built up. It has gone to the gym, gone lean, gone mean, and is all set to run extremely good from here. While it's not a recommendation, it's just an assumption. I think the next 2 3 years are looking very very solid. What I've seen, I may be absolutely wrong here, but what I've seen is Nifty returns cannot cannot ignore banks, of course, because it's also 30, close to about 30% of them are banks. But Nifty cannot go without banking contribution. So if banks have to go from here to the next level, sorry, if the Nifty has to go from here to the next level, then banks have to for sure contribute, and that is when Nifty will see higher and higher levels also. And the good thing is, because bank, especially in the last 1.5 years, haven't contributed enough to Nifty, when they come back, they should come back with a lot of rigor and vigor. That's what my belief is. So, if you are investing in a good quality bank or a financial services company or an NBFC, I think you should be able to make good returns, but it may give you a bit of a pain before you could actually start seeing some gain, which happens with any undervalued sector. So there are two strategies that you can use. Either you invest today a sizable chunk and keep a little bit away for you to add later at later point in time when you see some uptick, okay, in the banking sector. Or you say, no, I don't want to do some bottom fishing, which is also fine. I mean, I also don't do a lot of bottom fishing because nobody knows where is bottom fishing. When you start seeing some upward trend, so instead of buying a share at 100 rupee, you can actually buy it at 105. Yes, you're paying 5 rupee more, but there is a little more confirmation that you're thinking the sector is good, the thought process is correct. It is all starting to show results at this point in time. So I would suggest an option of the first option, where you put some now and some when there's an uptick, and not put all in one single shot. Similarly, you can do that strategy, or you may wait for a little longer, because I've seen that sectors don't turn around. It is never like a V shape. It is always like a U shape turnaround. So you may get some good entry points also. Right, Avinash? So just let me know if I answer that question. I will go to the next one. Mm, I don't know how to go here. Okay. So any questions before? Okay, I may get some sound again. Good. Okay, one more question. Good, Avinash. Yes, I think if you are investing in undervalued assets at a decent price point and not just blindly entering into it, you should be able to make money for sure, right? So, okay, now I'll move to the question that has come on YouTube. Just one second. Okay, so his question is, we do see a lot of communication from our end. It seems. So yes, so we have. Let me put it things in context. So we are going ultra aggressive and telling investors who have a 2 year investment horizon to invest in long dated government security funds. That is something that we have been very vocal about it for some time and have gone ahead and in fact created one good nice basket of long dated maturity government security, which means the credit quality is the highest in our smart beta smart debt solution in the app. If you go to the app, you will see that as a new section or a new basket that I've had. So this person wants to know more about it. Let me touch base upon it, right? So in the smart debt solution, we have created or invested in few funds who will then invest or lend their money into governments for a period of 5, 7, 10 years or so. So the average or the modified duration is about 8 to 10 year period. Just for an example, okay. You may want to go and check the fund also. It will be available in the smart debt solution in the app, Mira Money app. Now, what can happen is today government is saying I will pay you 7%. Okay, let's say from April RBI comes and says that the inflation is under control, everything else looks okay, let me start cutting the interest rates. It may just use the word let me start, it is not yet cutting the interest rates. With this news, the interest rates on the government securities will start coming down. One, tomorrow, because we have got included in JP Morgan index, we will see a lot of money flowing in. So there will be a lot of demand for government security paper. That will lead to the interest rates coming down because there's so much demand. Government will say, okay, I'll give this, I will pay lesser interest. Two, three, because the credit quality is expected to improve. You know, if you're a foreigner today, earlier you were asking for, let's say, 8% return. Now you're asking for 6% return or 6.5% return because the credit quality of the country is good. The borrowing is better. The credit quality is good, though it is not officially declared. So these three reasons can pull down the interest rates from 7% gradually, let's say, to 6%. Okay, gradually. So at the end of let's say 1 year or 1.5 years, which is let's say December next year, if the interest moves down from 7% to 6%, your bond paper, which is bond price, which is inversely related to interest rates, will come down, will go up by let's say 7, 8, 9% or so. So at the end of 1.5 years, you'd make an interest of 7% for first year, 3.5% for the half year, so 10.5%. Plus you'll make about 8, 9% because of capital gain, because of the bond prices going up. So you can net make about 18, 19% in 1.5 years, which would mean ideally you are making about 11 to 13% CAGR. So that is possible even today without you risking capital, without you giving your money to some random NBFC which is lowly rated and giving it to purely good government security paper. Now the question is, this is good only if you hold for a 2 year period or so, and this is like a surgical strike. You enter with a purpose, exit when your purpose is done. You cannot say I'll hold it forever, then the returns will come down. So if you want to know more about it, you can actually see our blog. You can actually download the app and straight away invest or have some examples. In fact, I have also written about it, made a video about it on my YouTube channel. Go watch it, right? And if you have any questions, please ask me there or write to us at hello@mira.money. Thank you for that question. Now, Sunil, my investment is mostly skewed towards mid cap stocks. Okay, shall I exit this completely and hold cash to enter when a correction? This is one of my very. I mean, correction is something which it's a very favorite word of mine. So let me take that part first, and then the mid cap part second. Okay, you're saying should I exit this completely and hold cash to enter when there is a correction? Now, while I agree to some part of it, why should you wait for correction? And what will you do if you don't have a correction? Here is my reason why I believe India's correction may not really happen the way you and I think. Today, the definition of correction is maybe 3 to 4% or 5% at best. Yes, that is not even a correction, right? That's a small dip. Earlier, when I started my career in 2004, the corrections used to be 10, 13, 15%. Today, Indian markets high and low range itself is significantly reduced. So people who are waiting for correction will continue to wait, because if your mind is tuned to 2014, sorry, 2004 or 2008 kind of a correction, I don't think it will ever happen during normal situation. Now, when can it happen? When there's a COVID, where you see 30% correction. Tomorrow, if the current PM doesn't win the election, you may pretty well see a 20-30% correction. Before that, I don't see any reason for Indian markets to correct by beyond 6-7% or so. So if that is what you call as correction, maybe you can wait out. But if you think you will wait for 10% correction, thoda sa difficult lag raha hai. Honestly, I don't see that happening. Okay. So I would rather invest my money and see my portfolio going down by 3-4% than wait for correction and never get the correction and never invest into the equity markets, right? So that is the second part of the question. I hope that part is clear. Now, Sunil, to answer your question, which says that I hold a lot of mid cap, um, mid caps definitely are looking a little expensive in our opinion. It may not be as expensive as small caps, right? It is not that very bad, but it is not cheap either. It is not rightly priced either. So if there are 4 5 matrix, one is cheap, which is great value, then it is rightly valued, then it is somewhere in the middle, and then there is overvalued. Mid cap is in the somewhere in the middle of rightly valued to overly valued, somewhere in the middle. If the earnings continue to be good for the companies that you're investing, if the earnings continue to be good and the valuation continues to be good for or the attractive for that particular stock that you're investing, then it is okay to take some profit off. Now I'll tell you how you may want to exit, right? You may not want to exit in stock and barrel one shot. What I would do is I would do three steps. First is I will take away some profit, not the entire amount. So let's say if I've invested 100 and today it's 140 rupees, I will slowly first exit 40 rupees off. Okay. Even after that, if it continues to be expensive, then I will start exiting maybe 50% of the investment that I made, which is taking some bit of the capital off. And even after that, if it becomes highly, extremely overrated in a very high danger zone, then I will pull off the entire capital also. So I'll do it in 3 stages and over a period of time, and not like press the sell button today and exit everything, provided the investment that you're making is in a fund or the stocks that you invested are fundamentally very strong. If you're invested by because of hearsay, one of your friends or your colleague came and said, "Ye stock acha lag raha hai, let me buy it," then I don't know. But if you're investing in a good fund, good fundamentally strong stock, then you do it in 3 stages and don't do it all in one shot. Now, my only suggestion is if you're exiting, don't get the money into your bank account and wait for correction. Mid large cap offers a lot of value. Move the money to large caps. Yes, immediately move the money into large caps. You can switch from mid caps to large caps. I hope I answered that question, Sunil. I know it's a long one, but I hope I answered it. If you liked it, please give me a thumbs up. I'm just waiting for the next question. I have one from. Great. So, hi Akshay, thank you for that question. Bond investment is best in the date now for FI, foreign institutions. Yes, today I think, you're right. Financial institutions, foreign investors are actively coming into India and investing, actually, not in equity. In fact, the holding of foreign investors have dipped to, 2000, I think a level below 2016. So you're right. A lot of money is already starting to flow in expectation of more and more coming in JP Morgan and things, because of JP Morgan inclusion and all this stuff. So you're right. A lot of money is coming in, and it will not stop here. It will continue to be there. And that's the reason why, if you have any investment which is lying in a debt fund, or if you're planning to invest with the lowly rated NBFC, because the NBFC is giving you 9-10%, I think you should look at investing in a good long dated duration government security fund also, which is very right, Akshay. Thank you for pointing it out. Um, Let me see the next question. Okay, thank you, Sunil, for acknowledging that you have got the answer. Okay, one question that is coming in. One question that is coming is, how do you get the number of 25,000 by June? Okay, finally, someone has asked me a question which I pointed out on the thumbnail. How do you get the number of 25,000? Let me tell you that, give you a little bit more background. So, we are currently in financial year 2024, okay, which will last for the next 28, 30 days or so, right? After that, we move to the financial year 2025. Mhm. So by December 2024, the end of this year, are the numbers that we all will look for, in general, analysts will look for, is not FY25. Though you're in FY25 era, because it's only 3 months of unknown, not 12 months of unknown. Okay, so what they generally do is they will look at FY 2026 earnings and start projecting and start looking, giving a valuation basis FY 2026 number in December 24. I hope I answered that till now. I have your this thing attention till now. Okay, so by December 2024, you will start looking at FY26 earnings and not FY25 earnings, right? Now that you're in December 24, the projection of FY26, as per most of the analysts and Bloomberg estimates, is 1,250 per share. This is the NIFTY EPS projection for the year FY 2026. Okay. Now, that is the EPS. The general PE range is 18 to 20 or 19 to 21. I'm just saying the general PE range should be 20, just for a calculation purpose. So 20, which is the PE, and EPS is at 1250. So 20 multiplied by 1250 is the number that one should make or have at the end of this year. Bare minimum, I mean, not bare minimum, but a rough estimation based calculation. So by December 24, I would not be surprised if we have Nifty at 25,000, and it's purely because of estimation, and market is in general a discounting mechanism and not a forward. It's never trailing; it is always discounting. Okay, it always discounts these news. 25,000 by December 24. I hope I was able to explain to you till now. Okay. Now, to answer your next thing is, why do I think it may happen by June? I am still using the word may because no one knows what will happen in the market. So it may happen in May primarily because when there is an election year, there is a lot of positive sentiments that gets built in, and there's an election rally that can happen, expecting the current government to continue and leading to this 25,000 number happening by either by May or by June. It may happen primarily because you expect the current government to continue, you expect the current reforms to continue, you don't expect disruptions in your thought process, and that would mean you will get 25,000 by June itself. And this is not unique to this government. I'm not saying this is unique to the current government. It was there during 2004, where the government estimated, oh sorry, where people like you and me estimated that that government will continue and started moving the market, only to realize that there was a new government. The market fell. In 2009, when it happened, people thought there'll be a hung assembly. So they never gave too much of importance to the market. It was flat or somewhere around flat. When there was a new government formed with the absolute majority, the market actually had an upper freeze, right? It means that market didn't expect this and it happened, and the market shot up 20% in a day or 10%, 10% in 2 days, as far as I remember. So in general, there's always a hope rally or a relief rally that you would always see in the market, because as I said, it's a discounting mechanism. So this year, the 25,000 number that you should ideally get by December may happen in June, primarily because of the hope around which the current government is going, current state of election is going to be in, right? I hope I answered that number, the reason why I believe 25,000 can happen by June itself. Okay. Okay, I may want to take a couple more questions. If you have any more questions, please let me know. I'll be happy to answer those. Sorry. Okay, I have one more question on my WhatsApp that is coming. Just let me just read through that. How do you suggest? Okay, so the person who's asked this question is currently doing an SIP, and it has got a small cap fund and a mid cap fund also. So his question is, should I stop my small and mid cap fund SIPs? The answer to that is no. You don't have to stop any of your SIPs at the moment, primarily because SIP is a good, effective dollar cost averaging instrument. Yes, for all you know, you will actually may see a little bit of a negative return for the investments that you make today. But to think of it, SIPs are a better instruments for a falling market than a growing market. You're getting my point? What I mean by here is, when the market is on the uprise, when you do an SIP, you're actually buying it at a higher price every time. So your cost of averaging is actually increasing. But that is fine, primarily because you will also see a downward looking market where you will buy SIPs at lower price every other time. Every other time your money gets debited and gets invested. So it's actually, to think of it a little contra, that you should invest in a falling sector more during via SIPs than during the bull phase, primarily because you will get more and more units and better price also, because the average keeps coming down. And in general, why is SIP a great mechanism? Primarily because it goes through a bull phase that you've seen already in small cap, like last year 2023. Every time that you invested post March, the price was higher. You are paying literally higher price and getting lesser units every time, right? And then you may have this year where the price may correct a bit, and you may see a little lower price. So your cost averaging works beautifully at this moment. So no stopping SIPs. In fact, to think of a little contra, you should increase your SIP allocation in small and mid caps, primarily because you will be ending up buying at a high price or so. But the clear cause and the reason here is very simple. You should be in a position to see a little bit of a red in your portfolio for the investment that you've added or made in your small and mid caps. If you're not ready for that, then don't increase your SIP, but don't stop your SIP. If you're ready to see a little bit of a red here and there, 2, 3%, 4%, 5% here and there, no problem, increase your SIP. So my last point here is, please make sure that you do not stop your SIP and increase your SIP possible. Okay, so then, okay, the related question there is, then what should I do with my lump sum? It's a big worry, right? In a growing market, we are all worried about We are all happy about what we have made in the past, but also worried about what do I do with my bonuses, what do I do with my lump sum money. In the lump sum category, as I've told clearly, you should avoid investing in small cap very, very clearly. Do not touch any of your then do not invest any of your lump sum in small cap at the moment, um, primarily because it is overvalued. Try and invest in most of your money in undervalued mega caps, which means, there are a lot of these companies which are today at available, large cap companies, top 50 nifty companies that are available at a great valuation. Try to invest in them, and if you don't have the time to do research, then invest in a few of the funds who will do the research for you. So my thought is, today if you have a larger lump sum, split it into three halves. Put 50% of your money today, put 30% of your money in the next couple of weeks, or 2 3, maybe a month or so, and then put the rest, or keep the rest. If you see some 2 3% correction, just put it off. So I'm okay to invest. If I have a lump sum, I would have put everything in one shot. But because I don't know you, I don't know your risk profile, I don't know how you would react to market falls and all this stuff. So I am suggesting a 50% right now, 30% in the month, and 20% if the market falls and if you see corrections like last 2 3 days back, you saw some correction, just add into those, in my opinion. So go in for a 50, 30, 20 kind of an allocation. Okay. So any other questions coming from LinkedIn? Now, people who are watching me on LinkedIn, if you have any questions, it will be wonderful if you could ask me those. It looks like it's a Friday, so a lot of people are partying, already getting ready to party. Okay, I have one last question which I'll answer. Let me just read through that. Um, so you said markets will come down by 20% if the current government doesn't come back to power. Yes. So how does one prepare for it? Okay, it's a very valid and a nice question. The question, if I were to rephrase, is we are all assuming a certain thing and are going big on the equity markets at this point in time. We are expecting the current government to continue, and that's the reason why we are investing heavily in the market. But if the current government doesn't continue, markets will correct or should correct by 20 30% also, not 30%, maybe 20% also. So what does, or how does one plan for such kind of an event? Super question. What I would do in April or May is something that I've thought about it. I may want to disclose a bit of that idea at this moment before we say goodbye to this LinkedIn session, right? So at this moment, with the kind of poll, with the kind of exit results, we are keeping a very close eye on what is happening in the states. While we are no political analysts, we don't understand anything about politics, but we are trying to just see information and gather information, saying is, if everything is on track, will there be an issue tomorrow, or do we see any kind of a disconnect or friction points? So at this moment, we are comfortably investing in the Indian equity markets, and expecting it to grow. But definitely, at some point in time, like, we have moved away from small cap at this moment. Even mid caps will also become into that zone. Even large cap will get into that zone or so. So my idea at this moment is, come May, mid May or so, I would want to keep at least about 10% to 15% of my money away from Indian equity markets, just to make sure that I am prepared for any kind of a reverse reaction or an adverse reaction on the expectation that we all have from the election results. In the sense, today, if the current government continues, you will make you know it is fine. If the new government comes in, we may see market coming down by 20%. Why do I want to wait till May? Is primarily because by then the election rally should maybe die down by then. It may not go beyond at after a certain point in time or so. So maybe mid May or 20th of May, we will pull off some and keep it ready, so that we will, if there's an adverse market, pump in that money into the market. Now, If the current government continues, the market may give you a 2 to 3% jump, not beyond that, because there's a hope rally that has already happened. So you know the results. If the results are as per your knowing, the market may not really value it as much, right? Because you already saw it coming, right? So it will may go by 2 3%, saying, okay, khatam hua ye khel. Now I can relax for the next 5 years or so. So there'll be something called a relief rally where the markets may go up by 2 to 3% or so. So I'm okay to pay this 2 to 3% cost for 15 to 20% of my portfolio around May, mid May end, as per the election results or schedules that we are seeing. But this may definitely change if we see super rally much before, if we see too much of an adversity in terms of, sorry, too much of risk in the terms of in pricing, we may change these dates before. But this is my broad thought at the moment, saying wait till May mid, wait till 20th of May, take some chips off the table because by then the rally should be there. And if it turns out to be good, maybe you have to pay about point. I mean, you'll end up paying 1 2% cost of if the results are the current government winning. If the results are against you, then you will have a bargain in your hand, so you can go big onto the market. I hope I answered that question. If you liked it, please do give me a thumbs up so that I know that you're all hearing me. Okay. No. Cool. So, any last question before we are just 3 minutes. We are just 3 minutes away. Any last questions? Anything that you want me to answer? You can type it out. Okay, today has been a little slow for some reason. I don't know. When I mean slow in terms of questions. Okay, so I will then end with my thoughts. The thing is, thank you. So, the thing that we believe is at this moment, even at investing lump sum at these moment is not a very bad idea. But considering the fact that we are all, we are all different people and we have different risk profile. So, my suggestion in general to a lot of people is that if you have lump sum, go in for a 50 30 20 plan where 50% of your money is invested today, 30% this year, and 20% sorry, this month, and 20% if you see a 2 to 3% fall at any given point in time. And if you are investing via SIPs, do not touch those SIPs. In fact, do the reverse, increase your SIPs in small caps, in mid caps at the moment, because in a falling market you will see the price getting better and better and better, because you will buy more and the units will be more, the price will be little lower, the average price will be little lower. So my thought is you should continue to stay invested at this moment. Do not look at exiting equity markets at this moment. Wait till about uh, mid May to take a call, to take a cash call. Do not hurry up and miss out on the 10 12% rally that can happen in large caps. I also have a case. I read through one of the brilliant reports that has come from one of the PMS firms. It is about investing in mega caps, top 20 companies. It is looking excellent at this moment. So large caps are deeply, truly, rightly valued. So there is still a long way to go. Do not exit at this moment. Okay. So thank you again for joining in. If you have any questions, please do ask me. Post this also, I'll be available to answer. And we have already created an app. My Mira Money app is already live. You can see 3 different baskets that is already created. At the end of the basket, one of the baskets is high growth basket that has got 90% of the money in Nifty 50 and Nifty low vol index fund, and 10% in Nifty mid cap index fund. We also have a smart debt product which helps you to maximize on your debt returns, provided you give me 2 years. So that is also available. Go download the app, check it out, and if you have any questions, do write to us at hello@mira.money. Thank you again, as usual, for joining in. I'll see you on Tuesday. See you. Bye bye. Good night. Have a good weekend.